Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Fibonacci day trading strategy, a method that can help you identify key levels in the market where price may reverse or consolidate. So by the end of this video, you will learn how to apply this strategy step by step, and let's get started. We start by understanding what the Fibonacci day trading mean. Now, the Fibonacci day trading is about using Fibonacci retracement levels to identify areas on your price chart where the market might reverse or stall. Now, these levels are based on the Fibonacci sequence, a mathematical series which each number is a sum of 2 before it before. Meaning we are looking at Fibonacci retracement levels, and these are the retracement levels on the chart: the 23.6%, the 38.2%, the 50%, the 61.8%. These are the levels that we are looking at on the Fibonacci tool. Let's bring it out so it's clear. The 78.6 level. They are all derived from the sequence and used to mark potential support and resistance zone. So these retracement levels are plotted between a swing high and a swing low in an uptrend, and a swing low to a swing high in a downtrend. I repeat, these retracement levels in an uptrend, the retracement levels are plotted. Let's look for an uptrend scenario to get a better feeling or a better understanding of how to plot your Fibonacci levels. Now, this is a good example of an uptrend. In this uptrend, if we want to plot our Fibonacci tool, you draw it from swing low to swing high. This is how you will plot your levels, and these are the levels that we are expecting price to reverse from. While in a downtrend, to plot this level, you just need to plot it from your swing high to your swing low. From swing high to your swing low. This is where to plot it. Now, the ideal is that the market often moves in waves. So reacting or retracing part is always part of their movement before continuing in the original direction. So by identifying this retracement, you can better understand where the market might find temporary support or resistance. Like you can see in this bearish trend, the movement of the market is usually in this phase. This is how the market moves. So understanding the ideology of markets moving in this way, you expect price to move in that way, and you capitalize using areas as these Fibonacci levels are areas that price ought to respect. As you can see in this area, when price got to the 61.80 level here, price respected that area and continued to the downside. Now, the Fibonacci retracement does not predict exact market movement, but provides a framework for analyzing potential turning points. It is widely used because these levels often align with areas of market interest where traders are active, making them self-reinforcing. So understand this principle so that it will be essential before applying them to your trade. In the next section, we are going to be talking about how we will break this tool down, a step-by-step way to applying it to our day trading strategy. We start by understanding that the Fibonacci trading strategy involves the Fibonacci retracement levels to identify key areas on the chart where price might reverse or consolidate from, helping you plan your precise trade entry and exit. So this is how we can use this Fibonacci strategy for our day trading. We start by identifying our trend. Let me clear this from my chart, and as we can see, we can identify our trend with series of in an uptrend you are looking for higher highs and higher lows, and in a downtrend you are looking for lower lows, lower lows, lower highs, lower lows, lower highs, lower lows. While in an uptrend, remember in an uptrend we are looking for higher highs and higher lows. In an uptrend we are looking for higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So this is how we are looking to capitalize on the direction of the market. You can also use tools such as your moving average or trend line to confirm your direction. And as you can see, if we are to use our trend line in this area, you can see price respects our trend line. Even in the bearish market, we can see price respects our trend line. So we can also make use of our trend line to get the market direction. So once the trend is clear, you select your most recent swing high and your most recent swing low. Now for an uptrend, you draw your Fibonacci tool from your swing high to your swing low. Now this is a typical uptrend, and we draw our Fibonacci tool from your most recent swing low to your most recent swing high. Now in a downtrend, the opposite is the case. You will draw your Fibonacci tool from your most recent swing high to your most recent swing low. This is how you draw your Fibonacci tool. Next is to watch for how price behaves at these levels. You pay close attention to the 38.2 level, your 50% level, and your 61.8 level, as these are often the levels that act as your resistance or support zones. You look for confirmation signals such as candlestick pattern, e.g. bearish engulfing, bullish engulfing, hammer. You can also make use of momentum indicators such as your RSI to validate your analysis. Once you have identified potential entry points at this level, you can plan your trade carefully. So let's see, if I'm to take this bearish trade at this area, when price has retraced back to my 50% region, I can see my bearish engulfing candle at that area. Bearish engulfing, you can wait for a retracement to that zone. This is the zone that we can spot, the 50% zone. We spotted our bearish engulfing candle that engulfed 1, 2, 3, 4 candles. You can wait for a retracement back to that area, or you can take your trade the moment you see a candle close. Remember, the moment your engulfing candle close, you take your trade. Remember, you put your stop loss just above your most recent swing level, swing high, swing low. In terms of a bearish trade, you put it up above your most recent higher low, your most recent lower high. This is where you put your stop loss, and you would aim for your 1:2 or 1:3, as the case may be. In a bullish trade, when you have drawn your Fibonacci tool, you monitor levels such as your 38.2 level, 50% level, 61.8 level. And as you can see, when price got to this area, price formed an indecision candle before an engulfing candle. You can enter your trade after your engulfing candle. You place your stop loss just below the most recent swing low. In terms of a bullish trade, just below the most recent swing low or higher low. You aim for your 1:2 or 1:3, as the case may be. This strategy works best when combined with other technical indicators such as your moving average or oscillators such as your RSI, your MACD, and so on and so forth. This would help you to reduce false signals and also help you to improve your accuracy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.